In the United States, auto insurance is regulated at the state level. Each state has its own set of laws, and no two states' regulations are exactly the same. This system of car insurance company regulation has been put into place for the protection of consumers. It encourages competition and helps to make insurance available and affordable. Among other things, the state can decide which criteria insurance companies are allowed to take into account when setting rates, and the state can determine what minimum coverage a policy must carry. The state legislature reviews and revises state laws and insurance regulations that car insurance providers must follow. They also establish and oversee state insurance regulatory offices, which are typically known as the Department of Insurance, or DOI. However, this hadn't always been the case. In 1869, the United States Supreme Court solidified state-based insurance regulation when it ruled in Paul v. Virginia. It wasn't until 1944 that the Supreme Court overturned the holding of Paul v. Virginia in United States v. Southeastern Underwriters Association, finding that insurance transactions were subject to federal regulation under the Commerce Clause. Almost immediately in 1945, the United States passed the McCarran-Ferguson Act, which specifically states that the regulation of the business of insurance by the state governments is in the public interest. This ruling has given states the power to require that every car insurance company files its rates and how they calculate them. This ensures that any two consumers with comparable rating factors will be shown the same rates. It also certifies that the policies are reasonable, fair, and include terminology that is easily understood, leaving consumers protected. Although this is in the consumer's best interest, it also may be a little confusing since mandated forms, rating rules, and the specific processes will vary from state to state. However, the states' methods can be generally categorized among 5 different regulatory structures: prior approval, where the regulator approves rate changes prior to their use; file and use, where the rate must be filed before use with no approval required; use and file, where rates are filed after they are used in the market; flex rates, rates can be used without notice with a specified range; and deregulated, where no state review of rates is required. It has been shown that states with stronger regulatory systems which require prior approval before they may go into effect are typically the most successful in keeping auto insurance costs down. To find the regulations mandated in your state, contact your state's Department of Insurance.